Hi there. In this video, we're going to be looking at influences in establishing a small to medium enterprise, but more specifically looking at market considerations and finance. So firstly, in terms of market considerations, you need to look at, are you going to be providing a good or a service? And the way you do that is to collect, summarize, analyze all information you can about what exactly the market and the customers want and need. You can't just start providing something that you have no evidence on. Is it actually going to succeed? Okay, that'll just be very pointless and very risky. So you need to look at, what do people want? What do they need? If all the data tells you that they want red t-shirts, and you go about then producing green t-shirts, and then your business fails, you then can't think and say, well, what went wrong? You didn't listen to what people wanted or what people needed. You also then need to consider the price as well. So there's a few things, a few ways you can look at price here. So you've got percentage markups, which is the cost is increased by a fixed percentage. So for example, something costs $100, has a markup of 100%, so it's going to cost $200. So if it costs $100 to make, and you want to increase it by 100%, you're then going to sell it for $200. Your profit will then be $100. We've got the recommended retail price, or RRP, as well. Now, this is only a recommendation of the price by the manufacturer based on how much it costs for them to produce as well. You've got price leadership and competition. A business can either lead the way in setting prices or follow the prices of other businesses. So there might be another business that has a very similar product. They sell it for $20, so your business also sells it for $20. Or you might take the lead and say, no, we're going to sell it for $18 instead, and try and undercut the competition to try and take some of their market share. Or you can base your prices on what the market will bear, based on what people are willing to pay and what's available. So if people are willing to pay $20 for your product, then you might sell it for $20. If they're only willing to pay $15, you still wouldn't sell it for $20. You'd only sell it for $15 because people aren't willing to pay $20, but they are willing to pay that $15. You need to consider the location as well. Now, you need to follow zoning regulations. You can't just start a factory up in the middle of a residential zone, for example. So you need to look at local councils' regulations for zoning here. Now, you've also got physical locations. Will you be set up in a shopping centre, a shopping strip, so like a mall? Will it be home-based, in your garage, in your backyard? Or are you going to be fully online? Now, increased online presence due to globalization and increases in technology have meant that businesses can operate 24/7 all around the world. So will you actually have a physical location as well as an online setup, or only online or only physical? In terms of finance, now, where are you getting the money from? So the first one here is debt. Now, debt is other people's money, in essence. And it comes from banks, comes from finance companies, comes from building societies. Now, the pros of this is you don't need to sell ownership of your business to obtain it. If you were to get shares, get people to pay you to buy shares, that means you're handing over ownership of your company to people. If you use debt finance, so from a bank, you don't sell the bank ownership of your company. However, you need to repay it with interest. That's the con there as well. In terms of debt, we've got short-term debt, so less than a year, and this funds day-to-day, the day-to-day workings of the business. It's also called working capital, and an example of this is a bank overdraft. Now, what that is you go to the bank and say, look, we've got a credit line of, say, $2,000. We need to take out a little bit more money to pay this month's bills. Can we have that? The bank might say yes or no. If they do say yes, the interest will be paid, normally daily, or it could be weekly. It's a bit higher, so you are going to be paying a lot more back for that kind of loan. So it's not something you do very often. You might do it once, on the off chance that you had a bad month in terms of generating positive cash flow. We've got medium-term debt. Now that's between 1 and 5 years. Now this is small expansions in equipment or products. So example of this is leasing. Now what that means is if you need to, get a new machine that prints T-shirts, for example, but you don't have the money for it, what you can do is you can have someone else buy it on your behalf, and you pay them monthly or weekly installments to use it. So you're basically renting it. So you don't actually outlay a whole slab of money in one hit. You're doing it on a week-to-week or a monthly basis, and eventually you're going to pay the whole thing off in a few years. And then we've got long-term debt. This is something that's paid over more than 5 years. Now, this funds large ventures, such as buying land and building, best known as a mortgage. You might pay this over 30 years. You take out $1 million loan, you pay it over 30 years for a certain amount of money per month, and eventually you own your business. So, with that in mind, if you needed to, pay the bills for the month, or you got a broken window and you need a bit of money, you're not going to take out a mortgage and pay that over 30 years in order to fix your window. You might take out a bank overdraft for that instead. So you really need to look at where you're getting your money from. Then we've got equity finance. Now this is your own money or your partner's money. So you start your own business, you bring in, say $50,000 of your own money, and then you take on a partner, and they might bring on $50,000 of their own money as well. So that's money. It's not coming from the bank. You're not paying it back with interest. So that's a pro. You don't need to pay it back with interest. However, the con is it might be hard to obtain. Okay, you might bring a partner on who doesn't have $50,000. They might only have $20,000. So in that case, you might need to increase ownership of the business to others. You may then need to say, well, I might need to take on another 2 or 3 people, each to bring in a couple of thousand, a couple of $10,000, $20,000, $30,000 each, in order to make up the money I need. But the more people you bring on, the more ownership of the business you give to others, and that increases the conflicts in decision making. Once you give people ownership of your business, you need to then take into account what they want and how they want the business to run. Now, in terms of the cost of finance, the price you pay for finance really depends on the type of finance. Is it debt or equity? Okay, if it's debt finance, say from a bank, from a finance company, you will have to pay interest on it for a certain amount of years, certain amount of months. If it's equity finance, you don't have to pay it back. So the price you pay for finance depends on what type it is, where it's coming from, and how long it's for as well. So a lot of those, there's a lot of variables there in terms of how much finance actually costs. Okay, money's not free, however, so there is always going to be a cost, whether it be a financial cost in terms of interest, or a non-monetary cost in terms of giving up some sort of ownership of your company to someone else. Now, there's some financial requirements in your finance as well. So when you start a business, you've got what we call establishment costs. So the costs involved in first starting the business or first establishing the business. So legal fees, furniture, fitting out your shop, for example. You need to pay that straight away. And equipment, okay? Once you've paid those, however, that doesn't end there. You've then got operating costs, which are costs involved in the day-to-day running of the business. So rent, utilities, water, electricity, gas, your wages, marketing, interest. So even though you start your business, doesn't mean that the costs then end there. You then still have to pay daily, weekly, monthly, yearly things in order to make sure your business can still actually operate or run. So you need to make sure that you're producing enough positive cash flow in order to maintain those operating costs as well. So I hope this very brief introduction to marketing considerations and finance has given you enough information to come to some sort of understanding of what they are and how they work. Thank you.